Good morning. Can you all hear me loud and clear? This thing reorganized real quick. My mute button's not on. All right. I'm not hearing anything or seeing anything. There we go. Okay. Thanks, Kevin. Wait, somebody's got to be here. Y'all are late like me. I'm only a minute late. That's fashionable, right? Or is it more than that? I don't know what the rules are on that. I've never been good at fashion, as you can tell. Can't even button my shirt up. Oh, I don't have my video on yet. Welcome to Trading Coach's Playbook. If you're new here, there you go. Now we can see. Not that it matters, but a little more fun if we can see each other, right? Of course, I can't really see you, so I guess that's one way. I had that turned down. Let me turn it down. Um, Give me just a second. I gotta go here. Let me get the disclaimer out of the way while I'm doing this. I think I can do this by habit. I'm not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade for regulatory reasons. We do not discuss funded trading. So, all right, turning this thing off. Mute, mute, mute. I don't want to hear it. All of a sudden, everybody likes to bother me when I'm trying to work, when other people are around. Like if 20 minutes ago, no big deal. It's like a little kid, right? They're just fine. And then once you are on the phone, they're tugging at your pants like, oh, they want your attention as soon as as soon as other stuff's going on. So um excuse me. But all right, now I can focus. Uh so here's all the stuff that's coming up. Premium online workshops, you got Inner Circle, and then Power Option Plays, Core Training, Mastermind Group, Trading You, free online workshop, Power Hour every noon, Trading Coaches Playbook, this one every Friday at noon. Uh, Kick You Know What with SPX. We can say that out loud, I think, can't we? Actually, my pastor just used it on Easter Sunday. He stood up on the thing. I can't even remember what it was about, but she said something about ass, and there was a couple little gasps. So he's like, "What? I can't say that from here." So it's like, let's be real. Uh, so yeah, it was kind of funny actually. So, and I know him; he's a good guy. We're friends. I so occasionally go have coffee with him. So, which I'm having now because it is only 9 o'clock on the West Coast here. So, and get a little pop. What just happened? Did news just come out? All I'm seeing is a quick little pop here in the last couple of minutes on the all the markets. So let me move that out of the way a little bit so I can see the Russell. But yeah, they're all four popping a little bit. We have a trade deal announced or something like that because I have a feeling when the first one's announced, the market's probably going to go crazy and get all excited. I think in the short term it'll pop, but I don't think long term it's going to matter a whole lot. But continuing on here, Power Option plays every Monday and Thursday. Cover Call Explorer with Trip on Thursday, and then E-mini Think Tank with Brandon is Monday, Wednesday, and Thursday. So, um, yeah, obviously I can't have the news running right now, so I don't know what, if anything, is causing this pop, but it's only on a few things. It looks like, huh? Yeah, if you guys see any news that's coming out right now, this market's very news driven at this point. Excuse me. Stupid post nasal drip still irritates me. It's part of the reason the coffee seems to help a little bit, or at least something warm. But you can find us on all those social media platforms. And then if we haven't met, which I think most of you I know, so I think you know what all this is about, right? In the interest of keeping this on time today, let's skip over this. If you're not familiar with my stuff, you know where to find me on Wealth Builders HQ. So, but let's talk about the topic of the day, which GDP came out Wednesday. Hello, Brenda. So that's what I'm waiting for is the cats to come out. I was waiting for you to ask where the cats are at. I'm waiting for them to come and bug me because I'm working. So they did that last night as I was doing my research. They both came and plopped down. The new one likes to sit right on the mouse and the keyboard right in between the two. I'm trying to work, trying to do my research and analysis and check the charts. Thankfully, it's made me appreciate the Maine Coon because she just sits over here on the side and leaves me alone. But anyway, the new one's a little more needy for attention. But basics, obviously, I think most of you probably know this. Recession is technically 2 quarters of negative growth, which we had in 2022, even though some people wanted to redefine it so that they didn't have this stigma attached to them. But it's always been 2 quarters of negative growth. Right? And there are some, some other people define it different ways, and now everybody wants to try to factor. Let's just keep it simple. A recession is 2 quarters of negative GDP growth. A depression is 6 quarters of negative GDP growth, which seems pretty reasonable. I don't think there's any reason to redefine or try to change it or anything like that because it is what it is, right? But on Wednesday, Advance came out negative 0.3. So the expectation was for 0.4% growth. The Atlanta Fed, what do they call it? Nowcaster. I hadn't heard that term until recently. It's like a nowcast. It's like forecast is looking out, right? But nowcast apparently was from the weather forecast, which they're not looking out, what's going to come tomorrow, but what's the weather going to be like in the next 3 to 6 hours. Apparently, it's kind of where it came from. And they took all these, they basically take all the economic data that comes in, and when it posts, when it gets recorded, it goes into this model that measures what true GDP growth is in a more real time fashion. It's a shorter time indicator, essentially. Because right now, I mean, GDP, and this is one of the things, is uh, like that third bullet point there, recessions aren't officially called usually until long after they're over. The '08 recession wasn't called until 2009 sometime. It was I think it was 9 months or a year before or after it was actually officially over when growth actually turned around. When they say, oh, we were in a recession. I mean, it's to a certain degree, it's kind of ludicrous because the reality is, and this is the thing, quarter 1 was January through the end of March. We're now at the 1st of May, and we just got the growth reading for the first 3 months of the year. So that's how far behind it is. It's not real time. It's not really that accurate right now. But the question is, what is this quarter that we're in currently? We're a third of the way through this quarter. And what does it look like now? Where's the growth rate at this moment in time? And we don't know, and we won't know until 3 months from now. So will it be negative? Will it be positive? There's a lot of factors that could come into play, especially right now with how I don't want to use the word chaotic because that's what all the talking points people are. Oh, it's chaos. It's chaos. Trump's chaos, and whatever. Uh, it's almost always chaos to a certain degree. It's just the question of what level of chaos is it. I wouldn't call it chaos. Well, I guess you can call it that. You can call it whatever you want. Turmoil. There you go. It's a good word for it. Call it whatever you want. That's one reason. I mean, I don't know why this just hit my brain, but and I love Ryan to death. But I mean, years ago I was working on changing my terminology from loss to cost, right? So I could mentally absorb it better. So it's a cost of doing business, and it's not a bad thing. But then one day I remember exactly where I was too. I'm driving the road and I'm thinking about this, and it's in my mind. It's going through this thing, and I'm like, does it really matter what I call it? I can call it a loss. I can call it a cost. The money's still missing out of my account. No matter how you term it, no matter what phrase you put to it or what terminology you use for it. I mean, it's just a semantics game at that point. But the larger point, the deeper point actually is to get your mindset wrapped around the fact that this is a business like every other business, and you have a cost of doing business, right? Walmart buys a whole bunch of product, they put it on the shelf, they mark it up to make enough profit to pay their employees, to pay the rent, to pay that, and still have a profit so they can reinvest in the business. Excuse me. But sometimes they get products in that either they don't move enough of it or nobody wants it, so they have to lower the price. And eventually they lower the price to where they're losing money. And that's just that every business goes through that. My dad was in business. He planted trees, contracting, not building houses, but planting trees. I mean, he's a forester, right? So he'd go out, they'd log 40, 50, 100, 200 acres somewhere out in the woods in Oregon. And, he'd come up and might have been federal land. It could have been private. Most of it was federal Weyerhaeuser, but they'd open it up for bidding. We got a 100-acre plot here. We need replanted. So he goes out and looks at it. How rough is the terrain, and does all his calculations, runs the numbers, how much man hours, all that stuff. And I remember him talking about, some jobs he lost money on because they go out and inspect and make sure they planted them right and things were done. And if for some reason, things weren't done properly, if his guys didn't do the job right, they'd either dock some of the money or he didn't get paid. He had jobs where he lost money on, for whatever reason. Sometimes he'd underbid them. And then his labor costs were higher than expected. So he planned for, to bid it for 50 grand or whatever the number was. I don't know what the numbers are. He didn't really get into that with me, but he probably mentioned it sometimes. But, if it's 50 grand and that's his expectation, he bids it for 50 grand. He's going to cost him 40 grand to do the job. It leaves him with $10,000 of profit. And then for some reason, it takes longer or some guy quits or whatever the case is, all of a sudden, it's costing him 55 grand to do the job, but he's only getting paid 50 because that's already locked in. The contract's signed. So he spent 55, but he only got paid 50. He lost 5 grand. Same thing in trading, right? So, but yeah, it's, yeah, exactly true. And that's the key. And I don't know if I said this, maybe I'm duplicating it, but the key is to shift your mindset to understand that losses are a cost of doing business. So whatever you want to call it, whatever floats your boat, have at it. Doesn't matter to me. But you have to learn to accept losses. They're just the nature of the beast. So it's not that big of a deal. But why did I get off on that tangent? Did I find that squirrel or did you? I don't know. Um, yeah. So I mean, the question really is, where are we at now, and where are we headed, and is it going to be a bumpy ride or not? And then we're in the middle of earnings season, and we're getting some good stuff and some bad stuff. Microsoft Meta came out and blew things away. Amazon, Apple, last night, not so great. So, um, exactly true. I found the rabbit. You just followed me down the hole. I like it. Is it a rabbit or a squirrel? I'll be the squirrel. You be the rabbit. We we follow each other. There's the $64 million question. Um, is this: How do we trade in a recession? What changes? And the reality is, pretty much nothing. I mean, if we're trading and you're trading based on technical analysis, even if you're trading off of fundamental analysis, I mean, that's obviously going to be a little bit different, but at the same time, you're still going to trade pretty much the same. But the question becomes, are there some strategies that work better in recessionary environments? Is it wise to lean one way or the other? In other words, and I was saying this 2, 3, 4 months ago, is that the vast majority of my trades at the time were bearish because I was expecting a drop. I'm expecting the economy to get worse. I'm still expecting the economy to get worse. I think there's some pockets of good things, but there's still a lot of storms that are brewing under the surface. And maybe they don't make landfall. Maybe they resolve and peter out, 100 miles offshore. That's always a possibility. Just like, I mean, you can look at that. That happens when hurricanes are coming, right? And they've gotten good at predicting those, so they usually can figure it out pretty close, but they don't know exactly where or when it's going to hit or if it hits. I remember years ago, there was one that was supposed to be this monster storm, and it petered out before it made it to shore. So it never hit shore. We could be in that scenario. Who knows? But yeah, it's a very mixed bag, which leads to the next one is, do you stay neutral? And the reality is we should always stay neutral, especially as traders. If you're trading short term, we should always be in a place where, okay, we acknowledge that we don't know whether it's going to go up or down. We can analyze and come up with, an opinion, an estimate, a prediction, if you will, put the odds on our side, but we really don't know. So it's best to stay in a neutral place anyway. But if you do have a bias one way or the other, like I'm biased to the downside, I think that we're headed south. So I am trading more bearish positions than I am bullish. Now, over the last 9 days, would have been better to be on bullish. I do have a bullish position, one, maybe two. I can't remember. So it's not like I'm not trading bullish, but my macro view, my big picture view is that we are either in a recession or very close to a recession right now. So, exactly, Miranda. Trade what the chart gives you. Did I say something that was misinterpreted or what? Because if I did, then whatever whatever's hitting your brain was not what I was thinking. I don't think. I don't remember what I said exactly, but I don't know if they do or not. But yeah, I'm gonna leave that right there. Another sip of coffee. So it seems like right now the economic data is very mixed. I mean, unemployment came out this morning. You probably saw that. It came in at 4.2. I expected it to actually go up because um, initial claims the day before jumped about 7 or 8%, higher than expected, or higher than last period, um, and quite a bit higher than expected too. So that's people that are initially filing unemployment claims. So if that jumps, then and granted that was just I think that's every week if I remember right, but that's not going to translate if it jumped by 15 or 18. I think it was 18,000. Then that won't translate into unemployment numbers for a while. So I would expect next month, especially if initial claims continues to climb over the next 2 or 3 or 4 weeks, then I would expect next month's unemployment number to tick up some. The question is how far. So, but it didn't go up at all this time. There's the other question too: is how much do we really trust the government's data? No matter who's in charge, they all want to make it look better than it really is, right? Almost always. So this begs the question: is it a time? Is it a good time to do more non-directional strategies like iron condors, covered calls, callers? Something that says, I'm not sure which way this thing's going, but I'm pretty certain it's not going to go up here or above there. So, well, real quick. Yeah, good. I get the mute button before coughing in your ear. Sorry about that. Um, the Atlanta Fed, and this is relatively new. I just noticed that they just launched an app in October of 24, which is what, a year and a half ago. AtlantaFed.org. They have the real-time GDP tracker. That's the nowcast they call it. So the Atlanta Fed has built a model that predicts GDP in real time. So it takes these different pieces of data that come in, initial claims, takes sales, the sales numbers, housing sales. I don't know exactly what is in their model. I think they have it listed on their website, but they have a model that says, okay, here's the data that's coming in real time, and it's going to adjust the GDP based on that information. And they went from, in Q1 at one point, it was showing 2.9% growth. And just before the data came out, like last week, I think it was showing a negative 2.4 or 2.7. And the number came in at negative 0.3, which it is called the advanced, right? Because they'll continue to crunch numbers and they'll come in and revise it. And if that revision isn't big, which it could, I mean, down 0.3, it could be revised up to, either flat or up 0.2. A half point swing. I don't know what's normal for those for GDP to swing from the advanced to regular or the first initial report to the revised report. I don't know what the historical swings are. Well, you go look that up, but this is interesting. I was poking around their site this morning actually and just kind of looking and see what they have. So you can play around that if you want. I just want to mention that so that if you want to check it out. But here's the interesting part because I was just doing this before we started. In fact, oops, that's not what I wanted. So let's just say, it all depends on where you're at, what you think this market is. And right now we're kind of, I mean, we made a lower low here, right? We had lower highs, higher lows here as we're running up from September of 23. Excuse me. And then we broke this low. So we now had a lower low based on the short term, but even in the intermediate term, we broke that when we cracked down here to this 500 level. We broke this low. So in my world, that says we are in an intermediate term downtrend. And the only way that gets negated is if we break above this level right here. Yeah, that's where that was before. 575. That's more accurate, I think. Yeah, that comes down intraday. So if we break above this 575 and we close up there, then we would technically be resuming the uptrend. So a lot of it depends on what you believe. If we're at the beginning stages of a bear market or not. In my opinion, we are. And maybe it's not. Maybe this thing just chopped sideways. But that's what I was looking at is if you go back to the last crash we had, recession, right? So if we are going into recession, we can analyze the chart because here's '08, and it's not, well, and here's where it got interesting, I thought. So we go from the very peak where it started and go down to the first, well, not necessarily the first little drop. This is the first big drop where the market started to really freak out. Not only did we have a head and shoulders, and that was the break of the neckline right there, but this is the first kind of panic sell off. This was just an orderly drop down to the previous support level, and then we came here, and then it sold off pretty heavy here, stalled out for a minute, and then boom, dropped off. So treating this as the first drop off seems like, yeah, okay, that's better. That's what I was looking at before, is weekly charts. I wonder what 2000 is like. That's right there. Or maybe I did go here. I swore I was looking at daily before, but let's go with this. So this is the first initial drop, and then a bounce. The reason I like this, it gives me percentage and how many bars. So 21 weeks it dropped 16%, and in 9 weeks it bounced 10%. That's weird. That's not what I was looking at before. No, yeah, that's not. Okay. Now I see what was different. It was on. Oh, come on. Well, yeah, there's where we officially entered bear market territory because that's the 20% drop. But I could have sworn it was, maybe it was right there. Because this is the first initial kind of, I wouldn't say panic selling, but first big kind of sell off. 16% in 72 bars. And then we bottomed out, bounced here, 12% in 50 bars. Now we go to current time and do the same thing on these from the peak down to the drop. And here's where I thought it got really kind of interesting is there's 19% in 34 bars. And there we go. That's about where we're at right now. In 17 bars, we're up 14%. I got to refresh my memory here. Where'd it go? There it is. So down 16% in 72 bars, and then it bounced in 50 bars. I guess if you move this out to that bottom right there, which is kind of, yeah, try to make it a little more. But again, I'm just trying to illustrate. So 18% 100 bars, 12% in 50 bars. And then we go to current. We got 19% in 34 bars and 14 and 17. You notice the velocity of the move, which back in '08, I mean, I was trading online. I know most traders were, but there's a lot more people trading online today than there were back in '08. And the speed with which news comes out, because we didn't have Facebook and all that social media stuff back then. So it's somewhat of a similar move, just significantly faster. You got 18, 19% drop, and then a 14 or 50% rally, which is what happens in bear markets, especially the initial stages of it, because people don't really know. So if we're at the first leg of a bear market, this is normal and natural, this retracement back to the upside. with the exception of the speed. And I thought that was the part that really kind of caught my attention of how quickly it was moved. And is it news driven? Yeah, but it's almost always news driven. And when things change, when the economy starts to get weak and shaky and the data starts to change and people start to get nervous, then they're like, eh. And then, over time, if it's true and it is actually getting weaker and the economy is getting worse, then that will play out over the next few months and continue to come out. And the data right now, we seem like a mixed bag. Like I said, earnings is very mixed. Some companies are beating and smoking things, and other ones are not doing that well. Other ones are guiding down and saying things are not that good. And it's in a lot of ways, it's been like that for the last 2, 3, 4 years. So I don't see anything changing. But again, getting back to the $64 million question, how do we adapt? And you know what? I'm curious now that I looked at that. Kind of wish I wouldn't have seen it, but what's the 2000, the initial 2000 spot? There it is. Because that was because here we had a pretty big drop there. The question is where this is the first initial kind of pop. This might be a little more relevant to what we got going right now. We had this drop here and then this bounce. Looks a little bit more like we have right now. So let's see what that is, just out of curiosity. Because this is when the bubble burst as far as .com was like, it's not everything it was cracked up to be. So 12% and 27, that looks a little closer to today's. I mean, the numbers aren't quite as big, but of course that was the spiders, not the Nasdaq was bigger, but we're looking at the same index. So 13% and 27 and 8 and 17. 13 and 27 and 8 and 17. Yeah, that's pretty close. That's a little more accurate. Again, in 2000, there was almost nobody trading online. So very, very few people were. So you got these different factors that are making the volatility and the velocity of the moves quicker. But you also got the bubble bursting too, which is what happened with the .com era. Because all of a sudden people are like, oh, this isn't everything was cracked up to be. So, but getting back to that question is how do we use that? Do we view this rally that we have going right now as a bear market rally? Is this the beginning of a bear market or is this the bottom? A lot of people calling this the bottom. A lot of these analysts and stuff like that. And I'm like, I'm not sure if that's accurate, but nobody knows, right? None of us have a crystal ball. And I don't see any really significant pattern here that says, we're really bottoming out. Could that be capitulation? Maybe. But the other thing that is a clue to me is that we've had this rally and the volume is not that spectacular. I wonder what's it like today on real time. Last couple days it's been good, but it's been dropping off too. So I don't remember what caused this. We had a big gap down and then rally back up that day right there. Let me zoom way in. So this day right here, lots of volume. You can see a big spike in volume, but the volume relative to the drop, the volume there, the volume on the rally back up is relatively light. It was still pretty solid on the big scheme of things, but it was below the average. And the average is elevated. But that also is another clue that says, okay, we're down really low volume here, and the volume average has almost tripled actually on a sell-off. So that shows that the bears are winning. They were especially here. And the fact that the bulls can't really muster enough to take it a whole lot higher. They obviously are bouncing it back pretty solid, but do they have enough muster to keep it going? That's the big question. So here's where I think it gets interesting, for me at least. And most of you know me, I think I am a directional trader, right? I'm buying calls or puts. But occasionally in moments like this, I'm looking at it, and I'm not a huge spread trader, but I'm looking at this chart and I'm going, the odds of this thing continuing to rally and bolt through 575 and go back up to 600, I think is pretty slim. I mean, to bounce from 490 to 600, it's entirely possible. It could. And again, if a trade deal comes out, if they come out and announce something has been locked in with, I think the first one's going to get a lot of excitement coming in. But I'm looking at this going, what about Nine Condor? News is mixed, data is mixed. Might not be a bad time to take advantage of a non-directional type of strategy that says, okay, we're probably going to chop sideways here for a while. Is actually what I'm kind of expecting, at least for the next week or 2 or 3 weeks. I would expect this thing to probably pull back and maybe just kind of chop around this area. So adapting a little bit. I mean, most of my other trades are still fine. We've got a couple that are underwater, a couple that are profitable, and the other ones are just kind of ho hum. So, but what was interesting, and this is one thing I wanted to show, is see if I can. Well, there we go. Is I pulled up the option chain on the spiders. And looked up a spread. This is the June, so we're out. It's 49 days, so it's a ways out. I mean, that's what, 5 weeks, 6 weeks? It's a super long chain. Good eye, Brenda. Yeah, the gap of 9 days ago was not filled. We've had this is 9 days. This is day number 9 that we've had up. We've closed in the green, which usually 8 days. You get a reversal after 8 days. 10 days is usually exhaustion, which actually that's a perfect segue because that leads right into what I'm about to show you, which again is not something you have to do. I might be paper trading it, obviously. So here's where I thought it got really interesting because I'm looking at calls obviously calls left, puts on the right. The yellowish is in the money, the white is out of the money. I'm looking at spreads and looking at, I mean, the resistance there at 575. So I'm thinking the 575, 576 spreads. The bid is 50 cents. That is one, two, three, four, five, six, seven, 8 strike prices out of the money. It was actually 10 strike prices out of the money when I initially put this in. Now we go 8 strike prices out of the money on the put side. Look at bull put spreads. One, two, three, four, five, six, seven, 8. They're basically 25 to 35 cents. So there is definitely a skew there. And what I was trying to figure out is like, what does that mean anything at all? And not really. I mean, they're maybe adding a little more volatility to the call side because that's where the interest is at right now because it's running up. So they know that they can sell the calls for a higher premium. But what they can't do, and that's the challenging part for a market maker, is that they can't skew them too much. If they skew it too much, then they leave it open to arbitrage. In fact, they're not even doing it. The computer's doing it essentially. And if you're not familiar with arbitrage, it's essentially where you're taking both sides of the trade, but creating a situation where you have zero risk, but you're still profitable, right? So I think the easiest way to explain it, let's use the spiders, but let's just say it's at 500. Let's say the stock's right at 500. You buy the stock at 500. If you can sell the $500 call for $5 and buy the $500 put for $4, you're putting out $500 for the stock. You sell the $500 call for $5. You collect $5. You pay $4 out to buy the $500 puts. So no matter where the stock ends up, if it closes at 550, you're getting called away. If it closes at 450, you're exercising it at 500, but you paid 500 for it. So you're not losing any money on the stock itself, no matter where it goes. But if you collect $5 on one side of the option chain and you only pay $4, you have a $1 profit and you have zero risk. You cannot lose no matter what. That's basically an arbitrage trade. I mean, there's other ways to do it. That's I think the easiest example that most people will be able to see and understand. You buy the stock, buy it at 500, sell it at 500, and you collect more premium than you pay out. Zero out. Except you got a guaranteed $1 profit. So that is the reason that they have to keep them relatively close. Otherwise, I know people have written computer programs that scour option chains looking for arbitrage opportunities, just like that. So that's where this whole thing about, I don't believe this whole thing that, your market makers are trying to screw you and this and that, take your money and this and that. You know what? They don't care about a little 1, 2, 300 contract trades, or I mean, 10 or 20 contract trades, even 1 or 200 contract trades on certain things. If you're trading Microsoft or Amazon, a couple hundred contracts is nothing to them. And like I said, most of it's computerized now. They're just adjusting certain things. I don't know exactly what they do, but I don't know if they manually do anything anymore. I talked to a market maker years ago, back in '08. Maybe it was before that even. I don't know. I had her on the phone about something and something about a market maker. She said, yeah, I'm a market maker. So I started picking her brain a little bit. It was really interesting, but it's been a long time ago. So I don't know. I don't know how much is done manually and how much is computerized. I imagine most of it's computerized, if not all of it. So, but it's really interesting to see there's such a major skew there that you go, eight strikes out of the money, bull put and a bear call. The bear call is selling for twice as much as the bull put. But here's one of the things that I did because I'm looking at this chart and I'm going, 575 is a major resistance level. It's the previous high. It was the previous low here where we launched off of. You can see there's lots of activity on it. We bumped our head here, then broke out, came back down to it, stayed below it for a couple days, and then bolted through it. So that is a fairly significant resistance level. So considering that I'm overall bearish anyway, and I'm looking at this rally we've had in the market, and the odds of this rally continuing to go and run all the way back up here to 600, 610, the odds are pretty slim. It's entirely possible, but I play the odds. And I'm looking at going, the odds of it going above that level are pretty slim. So why not sell this? If I can get 50 or 55 cents for it, it's a $1 spread, right? I mean, it's 49 days, so a lot can happen. But at the same time, it's 49 days. That's not that long. That's only, what was that, 6 weeks, 7 weeks? 7 weeks. 7 times 7 is 49. It's exactly 7 weeks. Hey, my calculator's working today. But I'm looking at it going, if I can get 52, 55 cents, even 60, I mean, 60 would be ideal, then I have a 1-to-1 risk ratio, basically. And as long as it stays below 575 over the next 7 weeks, and here's the beauty, if it drops off from here, if it drops back to 550 or 540 or 530, guess what? That's going down in value. And it might drop all the way to 20 cents. And then I could buy it back for 20 cents I want and bank $300. I mean, 10 contracts. I'm just playing around with this right now. But realistically, I have $500 of profit potential, $500 of risk on a 10 contract trade. But here's what I did instead of doing that is go down to 550, right? Because here's the support level. You go down to the 550, 549 bull put spread, drop an order in there for 50 or 55 cents, whatever makes sense. If this market turns and sells off and drops back off down to here in the next few days or a week or two, and let's say it fills this, if it fills it at 50 cents, let's keep the numbers round. So fill at 50 cents on the bear call spread. On the bull put spread side, it doesn't take any extra margin requirement because the stock can't be in two places at once, right? So throw an order out here for 50 cents at the 550s. And if it hits, then guess what I have? A quasi arbitrage trade. I have no risk. I collect 50 cents on the bear call, 50 cents on the bull put. I've collected a dollar on a $1 spread, minus commissions, of course, right? If you can get 52 cents out, that should cover your commissions. So then you have zero risk. No matter where the stock closes, you can't lose. But here's where it gets beautiful is you've got 550 to 575. So between now and June, if that other one hits and I eliminate my risk, if it closes between 550 and 575, which is a decent sized window, it's 25 points. And guess what? I keep the whole $1,000. I get 500 on this side, 500 on that side. I make $1,000 and I have no risk. So my hope right now is the spider tanks off enough to get that bull put spread to trigger, and then I'm in a beautiful position. I don't have to. I just sit and wait. I've literally collected $1,000 on $1,000 risk trade. I have no risk whatsoever, no matter what happens. And realistically, it can land anywhere between. Well, you got the extra dollar. Actually, I'm thinking mine's going to 10 points, but it could realistically land at 575.50, and you're still making 50 cents on that other half. So you have a 26-point window essentially. That all makes sense. I mean, no, I'm not a huge spread trader, but sometimes this hits my brain to go, I think there's an opportunity there to possibly kill it and minimize my risk. And I mean, my ultimate goal, and it took me a long time to get to that place, but I focus on risk. How can I reduce my risk as quickly as possible? I did this on the Russell a couple of years ago, 2 or 3 years ago, maybe it was in 22, when there was lots of volatility and it was going crazy. Because that's the other question is what do you do when there's lots of volatility? Because buying an option can be dangerous because the volatility is so high. They put so much air in the balloon that if they suck the air back out of the balloon, you won't make as much money, or you could actually potentially lose depending on what it's like. So how do you go from that environment? You go, okay, we're in a highly volatile environment. And instead of buying a call or a put, why not do an in the money spread? I did that on the IWMs. And which is the Russell, right? It's the Russell ETF, same as the Spider, but for the Russell. Collected it was deep in the money, collected 72 cents on a $1 spread. So my max risk is $280 on a 10 contract trade. All right, this thing rolls back over. There's a bull put spread. I was expecting it to roll back over. Of course, it hasn't. So I'm upside down. I've rolled it a couple times. And I just rolled it. It just rolled yesterday. I just put a little bit more at it. I'm like, okay, I'll take a little bit more risk. If it rolls back over, great. If not, I'll just eat the loss. And ultimately, it's going to be like 400, $500, something like that. So not a monster amount of money. But it's an idea, something to do. And the same concept was there is that if it would have dropped off, I could have done the same thing. And I could go do the same thing with that Russell trade as well. But I'm just doing it here on the spiders. The numbers just seem to work. So, or I mean, realistically, if it drops off, you could, if it goes down to the bear call goes down to 20 cents, you can just close it out and take that. So essentially, what you're doing is buying a put, but you're not buying a put. You're selling. So you're selling and collecting premium, doing an in the money bear call spread, which could have done that here as well. Actually, could have come down to well, let's see. There's where this is where mine starts to go a little bit crazy. And you'll notice that both sides they're pretty much equal on both sides, but there is which one's the one Iron Condor? There we go. These tweak my eyes, so I usually don't look at these, but okay, so there's that white is the one that's at the money, it looks like. Yeah, 568. Okay, so the white's at the money, everything else is in the money, so yeah, that doesn't make any sense to me. There's so many in here. There's so many different ways to do this, but This is one well, that's what I was saying. I did it on the Russell, the actual Russell index. I think it was in 22, maybe 23. And I'm pretty sure I sold the bull put spread first, collected $3 on a $5 spread, and put an order out for the other side for $3 on a $5. So the bear call. I ended up getting filled within a couple of days. They both filled. So I collected $6 on a $5 spread. So I was guaranteed to make $100 no matter what. There was only about a $10 window on that. And that was on the index itself. So $10 was almost nothing. But you can bet I was rooting for that thing to land right in the middle of that in the middle of that price. Because then I'm keeping the whole thing. I had a guaranteed $100 profit no matter what. And if it lands in the middle, I'm collecting the whole. I only did a couple contracts. That was the first time I did it. It worked out beautifully. I tried it a couple more times and they didn't work out. So I kind of got away from it because of that. But I mean, if you can do it consistently, if we're in a volatile environment and you can collect juicy premiums like this and then play it like that, if you can go, okay, this thing's extended on the call side as far as I'm concerned, it's probably going to pull back some. If you can eliminate your risk within a few days or a week and have zero risk, why not? Right? That's like I was saying, that's my ultimate goal is to get rid of my risk as quickly as possible and then still have a position there and give it time to play out and see if it moves big. It's one reason I scale so much. Because if I can get in and out, I mean, if I can buy a 5, 10, 20 contract position and take a 10 or 20 or 30% profit on part of it the same day, I do. I'll throw an order out there and say, okay, if it hits this, I'll take it. Get some risk off the table, bank some profit. Now I can relax and let the rest of it do its thing. If you find yourself in a place where you're placing trades and you get nervous, as soon as you place a trade, you're like, you're kind of on edge. You have trouble sleeping. Number one, you might be trading too big of positions. So scale back the size of the position. You should always be asking the question before you place a trade and while you're in the trade, am I comfortable with the amount of risk I have here? And if the answer is no, then either adjust the trade so you are, or don't trade it at all, or get out of the trade. You should always be comfortable with the amount of risk you have on the table. And when you are, then you don't put yourself in a position where you're making foolish decisions. Because I remember doing this myself, and I've met probably hundreds of traders that are like, yeah, I got into this thing, I was freaking out, I couldn't sleep. Yeah, because you got a $30,000 account, you just put $15,000 into one trade. If it blows up on you, you're wiping out half your account. I understand why you can't sleep. You got way too much at risk. So move the number down to a place where you're comfortable because I've made lots and lots of stupid decisions by having too much risk on the table. And then fear gets a hold of you. And it's like, And then you make a decision. It's like, what did I do that for? As soon as you make the decision based in fear or panic, usually it's wrong. Right afterwards, you're like, I shouldn't have done that. Done it hundreds of times myself. And eventually you learn, that's not a good place to be. So put yourself in a place mentally and emotionally that you won't do that. You won't freak out and make a panic decision. And the one way I know how to do that is that question is constantly in your mind. Am I comfortable with the risk I'm taking here? And that, again, going back to the scaling thing, that's why I scale out because then even though I'm comfortable with the initial risk, I get more comfortable, especially if it hits the same day or the next day and takes out some of my trade at a profit. I learned that in 2001 when I was day trading down in Vegas. It was pair trading stuff, but I didn't like it. But I started doing my own thing. Actually, I was doing it their way. They trained me how to do this. And like, I was upside down like 15 grand. It was their money, so I didn't have anything at risk. But and then I started tweaking it and doing it my way, and I made back like 10 grand in just a week and a half. I had 300 grand to trade with intraday. I had to be in and out the same day. But it was a pairs trading strategy. It just wasn't that effective. And again, so I started tweaking it, kind of like what I was doing here. But what I do is I go long 1,000 shares of something and then put an order at a nickel for 400 of it and have a 20-cent trailing stop on it. So what I did is, okay, I got a 20-cent stop on it. That's $200 of risk on 1,000 shares. If it runs up a nickel and it hits on 400 shares of that, not only do I bank 20 bucks, which granted doesn't sound like a lot. 2001, 20 bucks would, the family, you could almost take a family of four to McDonald's. Now you can't even take two people there. But anyway, I digress. Uh, so not only would it bank 20 bucks, but the other 600 shares that were there, the trailing stop would move up to where it was 15 cents behind me. So 15 cents risk on 600 shares is 75 bucks. But I banked $20 of profit. So I'm at 55. So I literally took a nickel move in the stock, which happened 95% of the time, 98% of the time. I went from 200 bucks of risk initially down to 55. And usually it happened within minutes, if not seconds. Especially when you're trading a stock and it's a more volatile one. It's like 5 cents is nothing. I think I was trading Fannie and Freddie a bunch back then. I don't even think they're public anymore, are they? Tells you how far back I go. But yeah, that's when I realized it's like, you know what? Get in with a decent size or whatever you're comfortable with, and then bank a little bit of profit as quickly as possible because you're removing by taking off 400 out of 1,000 shares. That's removing 40% comes off the table right away. 40% of your initial risk. And then by banking a small risk, that reduces it even further. And in that situation, I was using a trailing stop. That's why I went from being upside down 15 grand to making back 10 grand in like a week or two. And then they saw that what I was doing. They're like, you can't do that. It's against our rules. And I'm like, you guys are making money here. Like, making money. Why? I was losing money doing it your way. I'm making money doing it my way. Why are you stopping me? Like, let me keep doing it. Because their goal was to make a profit. It was a 50-50 split, right? So whatever I made, it was their money. It was their capital. But whatever profit was there at the end of the month, they took half, I took half. But I had to go back to doing it their way and ended up losing. And eventually I just like, I'm done with this because it's ridiculous. I'm trading their way, getting killed. And I'm killing it doing it my way. So anyway, all that makes sense. A little quiet. Obviously, I didn't blow anybody's mind. Wasn't that spectacular. It's really not. It's just an idea. It's just a thought that, if you do this, then depending on how it plays out, it can play out spectacularly and you can absolutely crush it. But I mean, realistically, worst case scenario at this point in time, considering I got filled at 52 cents, right? On this practice trade. I have 500 bucks of risk. Worst case is I'm going to lose 500 bucks. If the SPX takes off and rallies in the next 7 weeks and closes above 575, which granted is possible, but it's a one-to-one risk. And on a spread, that's actually, I think, pretty good. It's one reason I don't love spreads is your traditional spread is, you're picking up 20 to 30% profit potential. You're getting, $1 and $5 spread or 25 cents on a 20 or 25 cents on a $1 spread. You got 25 cents of profit potential, 75 cents of risk. That's the risk reward's out of whack for me. But like I said, if I could get a 1-to-1 ratio on a spread, and especially this, it's out of the money. I mean, it's got some time, but if it rolls over from here, which is what I would expect some more profit taking to come in because we're still seeing that. The rallies you can see on the intraday charts when you go look at it is that there's a lot of people that are selling the rallies now instead of buying the dips. So if this thing will drop off 5, 10, 15 points, 20 points, the other side will probably trigger, and that would eliminate 100% of my risk. That's what I want to have happen. And then I want to just dance around there. And on the third Friday in June, I want it to close at 560. And then I keep everything. That's the ultimate, right? It didn't happen on that Russell trade I did. It didn't happen, but that was only like about a 10-point window, and it didn't close inside there. So I only made $100, but it was $100. It was 2 contracts, or no, it was one. It was one. That was the first time I tested it. It was 1 contract, so I made $100 minus commissions. But I would have made 600 if it would have closed in a 10-point window. So with zero risk, no risk whatsoever. So again, Fun, fun. Any questions? I'm actually going to wrap up a little bit early today. Squirrels. Where? I don't see any squirrels. I like squirrels. Am I still bearish on the market overall? Yeah, right now, unless something changes. And we have the Fed's coming out next Wednesday, so it'll be interesting to see what he says. Um, and that's why I'm still leaning bearish. I think this is a bear market rally is what I think we're in right now. But that's what's goofy is the news is so mixed. It's hard to say what what's going to happen. But like I said, even earnings is mixed, and it's been like that actually for a couple of years. You got some companies that just absolutely are coming out and killing it, and some that are getting destroyed. So it's uh it's a very mixed bag right now, which definitely makes it challenging. But um, so yeah, it's get it in and out as quickly as possible, as far as I'm concerned. And that's another reason that even though I don't do a whole lot of iron condors, the last time I did one was the Russell when I was playing with that a couple years ago. And it just hit my brain a couple weeks ago. I was like, this might be an opportunity with the volatility and the velocity we've had to do that again. And so we'll see how this one plays out. If you remind me at the end of June, I'll let you know. See how it turns out. But I think the odds are pretty high that I'll come out profitable, considering the rally we've had is significantly bigger than, well, maybe not. I shouldn't say more than it should be, but it is what it is. It's rallying what it's doing. So we shall see. But I think the odds of it staying above 575 in the next 6 to 7 weeks is pretty slim at this point. But news will determine and what happens with that. I think with the Fed coming out next week and if a trade deal gets announced, I can see it taking off. That's why ultimately I'd love to see next week early, maybe when the Fed comes out next week, if he comes out and tanks the market like he usually does, maybe this thing drops off to 550 and it fills that other side. So the ultimate goal is to get filled on the other side. Once that happens, if that happens, then I don't care. Then it doesn't matter because I have zero risk. So, and it's been crazy, huh, Roman? It's been super nice the last 2 or 3 weeks. Almost no rain. So I don't know if that means we're gonna have a hot, hot summer or not. But so anyway, yeah, I haven't ever done the butterfly thing, so I've seen them a little bit. And I never really dug into deep enough to understand them in depth. So I mean, I did when I was looking into them, trying to figure it out. I understood it, but it's not something I do on a regular basis. So oh, nice, way up north. I'm going way up north tomorrow too. Actually, you got a friend's birthday, so I'm riding with the neighbor, so I don't have to drive. I can relax, which is nice. It's a 2 hour drive, so. All righty, y'all have a amazing day. Have a great weekend. Hopefully, it's nice where you're at, and we'll see you on the next one. All right, God bless. Bye bye.